model that we use is called the tax PI model. So let me just step back and describe a little bit how our modeling and our software works. So we start with our core economic and demographic policy impact model. That's called PI+. The PI stands for Policy Insight. That allows us to look at the economic and demographic impacts of a wide variety of economic and tax and other types of policy. The tax PI model is built on top of that core model and adds a module that allows us to capture the interplay in between the budget, the state budget, and the economy. So in this case, we built a model of the state of Arkansas, and so we were able to capture the interplay between the economic and demographic situation in Arkansas and the state budget. So for example, you'll see the first line in red that says user-defined revenue and expenditure categories. What that means is that we're able to input what the actual budget was. So this is what our income tax revenues were. This is what our sales and use tax revenues were. Actually, on the expenditure side as well, what was our spending on education? What was our spending on health and human services, et cetera? And we're able to link those to economic variables. So for example, we're able to link personal income tax revenues to, for example, personal income. So as for example, if more people move into the state and bring their personal income with them, that's going to be a bigger tax base and that's going to increase revenue. And so that's kind of how that model works. And on the flip side, it allows us to look at what are the impacts of tax policy on the economy. So for example, if you lower taxes, again, that's going to generate an influx of population and potentially jobs, and that can feed back into a secondary effect on the budget, which is what we're doing with this dynamic scoring analysis. And so just to give you a sense of what you'll be looking at when you see the results, just as a preview, we'll be presenting results for each of the 5 years between 2019 and 2023. So it'll be a 5-year window that we're looking at, and the results will be the model is an annual model. So you'll see impacts in each given year. And so just to kind of step back and give you a sense of exactly what the model is doing conceptually, is we generate a forecast of the Arkansas economy, of the Arkansas demographic population, of the Arkansas budget, using a variety of government, usually federal government data sources, including the EEA, the BLS, the census, and several others, depending on which economic and demographic variables we're looking at. And we generate a forecast that goes from the current year out for about four more decades. So we have a long window. We used only a short window for this analysis, but we have more capacity. What we look at is to say that's kind of the business as usual case. If none of, for example, in the case here, if none of these proposals pass, this would be a reasonable expectation of what the economy and the population will look like going forward. So you can think of that, looking at the slide here as the red lines, what we can call a control forecast. So for example, we can say that's the forecast of, for example, jobs or population. And then once we input the particular tax proposal that's going to have some effect on the economy, we can look at the outcome in that scenario. We can think of that as the blue line. And the impact in a given year is going to be the difference between the business as usual case and how much that tax proposal changes the outcome relative to that business as usual case. And just